If you want any chance of being successful when investing into commercial real estate, you have to understand how the NOI, the cap rate, and the value are used together when underwriting any commercial real estate deal. I talk to people every single day who either have no idea what they mean or, even worse, aren't applying them correctly when making their decisions before investing into multifamily real estate. When done correctly, you can be one deal away from retirement. No joke. But when used incorrectly, you could be spending your time and your money invested into a deal, making up for mistakes for the rest of your life. My name is Guy Bouchard, and I have bought and renovated many apartment buildings and generated millions of dollars buying and renovating apartment buildings. But knowing exactly how to identify the opportunities and extract the hidden value in those assets is how I found my greatest success. And in today's video, I'm going to teach you the 3 lessons of NOI, cap rate, and value so that you can determine exactly where the hidden opportunities are in an asset, or more importantly, where they're not, so that you can move on to the deals where you're going to find your greatest success. So look, when I started out buying commercial multifamily real estate, I understood what NOI, cap rate, and value all meant. But what I didn't truly understand was how to apply them to get what I was looking for. I was more just trusting the information that I was being given from the seller, the realtor, the mortgage broker, the lender, and based on information that we were playing with. But what I didn't truly understand was how to apply that math to my value, to help me in negotiations and help me in future projections and help me really understand where I was either paying too much for something or where I wasn't able to use that math properly to unlock hidden value that was fully there. So understanding the formula is extremely important so that you know how they all work together. But understanding each individual one and how you can use that to apply it to values to help you understand what the real true value is, not just based on information that you're being given, but from an experienced operational standpoint, that's where the magic happens. And that brings me to lesson number 1. What does NOI mean? So the NOI, also known as net operating income, is exactly what it stands for. You take the gross revenue of an asset. So let's just say in this case, the gross revenue is $1 million. So that is all of the revenue that it generates in rents, in parking, in storage, in utility clawback, you name it, whatever it is, it's the top line revenue of an asset. And then what you do is you subtract operational expenses, okay? So let's just say, in this case, we're talking about operational expenses of 50%. That is $500,000, and that represents taxes, insurance, maintenance, management, and services or utilities, whatever you want to call that. Okay? Those are operational expenses that are applicable to every single multifamily asset that exists. Some people use or have some of those components, some people don't. But they still have to be taken into consideration and accounted for when calculating your NOI, when calculating your operational expenses, so that you can get to the NOI, which is your gross revenue minus your operational expenses. So in this case, we've got a 50% operational expense. 1 million minus your $500,000 in expenses leaves you with $500,000 of net operating income. Now, not everyone is one and the same. Like I said, some people might manage their own building. So when you're looking at operational expenses for a certain asset and it doesn't have management in there, it could be because the operator or the owner is managing it themselves, which would change the operational expenses, and by effect, the operational expenses might go down. So let's say they're managing it themselves and they go from a 50% expense ratio to a 40% expense ratio because in this case, they don't have management in there. That would change the operational expenses from 500, let's just say that it saved them $100,000 by managing it themselves. Well, that means that on paper, their operational expenses would show as 400,000, which means 1 million minus 400 leaves you with $600,000 of net operating income. This number, no matter what it is used to determine the value in conjunction with the cap rate and the value, which I will show you further in this video on the next lessons. But for now, it's just understanding what the net operating income is. Now, it's super important to understand that the information that you're being given is usually being given to you in a way to present the best picture possible, because if it makes more money, it's typically worth more money in the value. And so what somebody else's operational expenses are not necessarily what your operational expenses are. And your job when trying to determine what the net operating income is to not believe other people's story. Just because you're going to manage your own building doesn't mean I am going to want to manage my own building. I want my buildings managed. And that goes for all of these things. Each of these items are a little bit subjective in the way that how somebody else manages their building is just not how we would. If somebody bought their building back in 1905, their taxes on their cost basis are going to be much, much lower than what yours would be purchasing that today. Somebody might have group insurance. They might own 100 other buildings and they get this massive group policy that gives them an immense discount on their insurance, which means that theirs is going to be a lot lower potentially than what yours would be. And that goes for everything here. The maintenance, somebody else might not maintain their building the way that you would. They might manage or not manage their building the same way. And then services and utilities. Someone might have the tenants paying for the utilities and someone might not. All of this it's good information for you to receive from them so that you can understand what its current operational expenses are, but it's your job to make sure that you understand what the net operating income will be the day you close on the building and not believing their story. In a lot of cases, someone's going to try and show a lower expense ratio so that they are showing a higher net operating income so that they can present a building that looks like it's worth a lot more money to the actual buyer than it really is. If you're finding any of this information useful, you can click the link below and download my one-page Unreal Blueprint, which shows you the step-by-step process that I've used to buy, acquire, renovate, sell, and keep multifamily assets. All right, so that brings us to lesson number 2. What does cap rate mean? Which is a term used to define how much return you are going to get on an income generating asset, assuming that you paid cash for it. So this has no debt attached to it. So in this, using the last example of $1 million in gross revenue minus a 50% expense ratio, that left us with a $500,000 net operating income. let's just say that that building that was making that $1 million of gross revenue, let's say that that cost $10 million to buy, okay? So building equals $10 million. Doesn't matter if that building is a 10-unit building or if it's a 1,000-unit building. It doesn't matter. The point is that it makes $1 million, okay? So in the example before, we're paying $10 million for a building that had an NOI of $500,000. What you do to figure out what your capitalization rate is on a $10 million investment is you divide those two figures together. And so if you divide $500,000 by the $10 million that you have invested into that, you are going to get a cap rate of 5%. That means that your money that you have invested is making 5% every single year. Now, cap rates not only are the formula of telling you how much that the building is making, but it's also what the lenders and the brokers will use to value an asset based on the area that it is. And typically a 5% cap rate area, that would be considered a low cap rate, which means that the building is pretty expensive compared to how much money it's actually making. These are going to be areas like your major city centers. They're going to be your Chicagos and New Yorks and LA and Vancouver and Toronto, wherever it is where there's a really dense population and there's a core city center. That's typically where you're going to find these low cap rates. When you start getting further and further away from those areas, your cap rates tend to go up, which also means that your values tend to come down. They're in relation to one another. Let's just say that that same building, that same 100-unit building, whatever it was, that would cost you $10 million in a city center. Let's just say that you went 1 hour out of that area and that building, that same building, was now $5 million. It's half price, but it's still making the same $500,000. Now you take the same $500,000 and you divide it by the $5 million that you have invested into it, and then all of a sudden you have a 10% cap rate, which means that for your $5 million that you have invested, you're making $500,000 a year on that, which is giving you a 10% capitalization rate. 10% return on your money every single year without any debt attached to it. The reason that this is important to understand, of course, is because your NOI is going to fluctuate, and it definitely changes the capitalization rate. However, the lenders and the areas kind of determine the capitalization rate as well. So they do work one and the same. And a lot of times what you're doing is you're figuring out what is the cap rate of that area? What are things trading at? Because it wouldn't really make sense for you to go into a downtown city core and find a 10% cap rate building being sold on the market when the area cap rate, like the sales comparables and the other buildings selling in that area, are usually selling at around a 5% cap rate. And so although it's a mathematical equation to give you the cap rate, it can also be used in reverse to know what the area cap rate is, so that you can use it to apply it to the net operating income to get your value, which is, of course, you want to work this way as a buyer, but it's more the sellers that are working at it. The sellers and the realtors will take the cap rate of the area and then apply it to their NOI to get a value, which is why, of course, that the NOI is super important, because when you take the cap rate of an area and apply it to the NOI, it's going to give you your value. So the higher your NOI is, the higher your value is, which is why you have to be very, very careful what you believe when you're looking at people's net operating income. Because if you're just applying a cap rate to whatever they tell you, you are paying their number, not necessarily the number that's going to make it a good deal. Lesson number 3 is, what does value mean? Well, value is different for everybody. What might be okay for me might not be okay for you, and it might not be okay for the next buyer. It's always going to be the same. Now, value is the output of cap rate divided by NOI. Now, that gives you the value or sticker price, but value is different for everybody. For me, value is in the appreciation or the value that I can add to an asset. It's not necessarily what I'm paying for it the day I close, although there is value there, of course, and by value we're talking sticker price. But for me, the value is how can I increase the value? How can I change it from what it is today to be worth something more tomorrow so that I can extract that value out of it? And so in the examples that we used before, we're going to take a building that is worth $10 million. And let's just say that the expenses on that building, or sorry, the revenue that we were generating, so the gross revenue, the gross rev, like we said before, was $1 million. And the expenses were $500, just like we talked about. And we've got a $500,000 NOI. Let's just assume that all of the expenses were real. The taxes, the insurance, the maintenance, the management, I believe their numbers. But let's also take a look at where they're getting their gross revenue from. If their gross revenue in their building, let's just say that each unit was renting for, let's call it $800 a month. Okay? Oops, I got 800K. That would be really nice. Not going to be a thing. 800 a month per unit. I'm not going to get into breaking down how many units the building has for this video. You can watch it in another video that I've done that breaks it down in more detail for the actual value add component, breaking that down. But right now, all I care about is this gross revenue number, and all I care about is that they're renting at $800 a month. And let's assume that this building was in an area where you could double the rents. Okay? You can just simply rent them, take them from $800 a month, and you can turn them over and you can get $1,600 a month. Now, I know that's a big jump, but I'm just doing simple math here for a reason, just to make it easy for the presentation. But let's just say that those can go to $1,600 a month. Is this possible? Of course it is. You can have, this is the value add component. These are owners that have owned their buildings for 30 years. Maybe they haven't done any work to them. They've got old tenants with 30-year-old leases. They never cared about raising the rents in the building because they're happy making their $500,000 because they didn't pay $10 million for the building. They probably paid $1 million for it back in the day. There's a lot of reasons why the building is going to have rents that are much lower than the market value, and that's where the opportunity is. So for me, I look at this and I say, okay, Would I pay $10 million for a building that only generates $500,000 or give me a 5% capitalization rate? No. I'm personally not interested in buying things that only generate a 5% interest rate. What I am interested in, though, is taking it from $800 to $1,600 a month, because what that would do, it would effectively double the rent, which would double the gross revenue. So now all of a sudden, this goes to $2 million of gross revenue. And the expenses would go up with it. So it's, it's likely not going to stay at 500. So again, we'll just assume that the math doesn't change. And this goes to $1 million, which is the same 50% expense ratio. Now all of a sudden, the net operating income changes to $1 million. And if you apply the same math, which it always is the same, just the numbers change, but the formula doesn't change, you're taking now your $1 million of NOI, net operating income, and dividing it by the cap rate of the area. So let's assume that the area, this is still in a downtown core, you're not dividing it by the $10 million anymore, you're dividing it by the area cap rate, because you bought it in a 5 cap market, you're going to sell it again in a cap market, or if you don't sell it, the lender is going to give you value based on the cap rate of the area. So you take this $1 million and you divide that by a 5%, I'm going backwards on my stuff here, a 5% cap rate, and you get a $20 million value. You've doubled the net operating income, haven't changed the area, the downtown core didn't change, it didn't all of a sudden become a crappier area, it's still a 5 cap market. And so you would go back to the lender and back to the bank at that time, and you would say, okay, I've now taken the revenue and doubled it, and here's my new net operating income. They're going to take the cap rate of the area and divide it by your new NOI, and they're going to go, yep. They're going to want to see financials and paper records and leases, and you're going to have trailing financials that show you that stuff. But at the end of the day, you're going to get a valuation somewhere in the neighborhood of $20 million. Now, you just created $10 million of equity in this scenario. You've also, of course, increased your bottom line, which means that you've just turned a 5 cap deal into a 10 cap, because for you, it's making you $1 million on your original $10 million. So even though the value has gone up, that doesn't change your cap rate. That doesn't mean that you're getting a 5% cap. It just means that you could sell it for that. And you've done the work to get it there. If you take 800 and only increase it by 50%, which would be $1,200 a month, that would be 1.5 of new gross. 50% expenses would be $750, which would give you a $750 NOI, and you divide that by the same 5% cap rate, and that's going to give you a $15 million valuation. And so being able to understand how much you actually do control the value of the asset based on how much it makes and how much your operational expenses change is the key to everything. And it's key not only for what you can do to the building to make it worth something in the future, but it's more key to make sure that you're not believing somebody else's story and not overpaying for an asset based on numbers that you don't verify or that the seller's giving you, or it's just not the reality the day that you close it. But understanding how this works gives you the ability to do a gut check on every single deal that you look at and quickly assess whether or not it's something that you want to get involved in, and that you're not going to get into it thinking it's a 5 or a 10 cap and then realize that all the expenses, half of them were missing, and all of a sudden you wind up getting half of what you paid for and your money's locked up in a deal that you can't sell, or you overpaid for an asset that you can't unload. Or in a lot of scenarios where people do get in trouble, the interest rates fluctuate and the mortgages change, and then all of a sudden the little changes in the market have a major impact, and now you're putting money into it every month rather than getting money out of it. And so understanding the relationship between these three things is the key to understanding the value of multifamily real estate and any commercial asset for that matter. Now, it's very likely, just a caveat, it's very, very likely in our value add strategies that you're not going to find a building that you can just go and double the rents without doing any work to it. The value add component usually requires a construction or renovation component. So it's nice to think that you're just going to buy it when it's $800 and you're going to get a market value for that and you're just going to go in and double the rents. Are those deals out there? Of course they're out there. But in reality, you're probably going to buy it for 10 and then you're probably going to have to dump some money into it for the construction and the renovation, which is not illustrated here. Again, more detailed value add videos that you can go and watch that I've done to break this down in more detail. But all intents and purposes, you just have to understand, I'm going to pay 10 and then I'm probably going to have to invest, $2 to $3 million in order to actually get people to want to pay that $1,600 or whatever it is. And these numbers, of course, are going to change greatly and they're going to vary depending on area and what you're planning to do to the building and all of that stuff. But for the most part, it's just really understanding the relationship between these three things. So now that you know what cap rate, NOI, and value all mean and how they work together, you can use this math to very quickly sort through many, many deals in minutes to determine whether or not there is value for you to even continue the conversation or whether you're just wasting your time, you want to get to the next one. Hope you guys found that helpful. We'll see you on the next video.